The Australian share market traded in and out of the red before finishing as the major banks struggled on news the corporate regulator recommended stricter lending assessments. The benchmark index closed down 4.2 points, or 0.07%, at 6,059.4, with miners countering weakness in financials and other domestic-focused sectors. NAB's small business survey also pointed to ongoing loss of growth momentum after it fell for the fourth straight quarter, with retail conditions the weakest by industry. We saw a decline in property and construction, a result in line with the developments in the residential property market. Health and business services also saw declines in the quarter, he said. The Australian dollar bounced off overnight lows at US 70.90 and was trading slightly easier at US 71.15, while government 10-year bond yields were slightly softer at 2.148%. SBC strategists said that there were growing risks that the downturn in the credit cycle leads to slower growth and that the effects were being masked by stronger terms of trade, with the dollar likely to reflect the fallout. The economy and the dollar were vulnerable to external exposure, particularly to growth in China, and the high levels of household leverage. Faced with a negative economic shock, the process of getting back to equilibrium usually requires a mixture of lower rates and a weaker currency, they said. The dollar is familiar with its role as a shock absorber. It is often cited as one of the main reasons why Australia has avoided a recession for close to 28 years and counting. Overnight, the USS sent as markets awaited fresh news on U.S.-China trade negotiations and tomorrow's U.S. non-farm payroll report, which could prove to be a double-edged sword, with a strong number increasing the risk the U.S. Federal Reserve would revert to its rate rise cycle. The Shanghai Composite Index was down 0.3% at the close of the ASX, facing its first loss in 4 days amid warnings of mounting bond default risks that underscored the fragile state of its financial system.